So below little, I've been in the business for about 20 years, working for asset managers on the distribution side, wholesaling investment products directly to financial advisors. And while I was doing that, I spent a lot of time also teaching financial education because I realized that there's always a gap, right? The gap is information and access provides opportunity for a lot of people. And for me, being on one side of ledger and understanding the need to provide some information to the other folks was always important to me. So I'm here not only for personal interest and reasons, but also the exchange. I think we're trying to modernize our approach and understand retail a little better to drive better resource allocation, but at the same time, figure out what we can do to support the industry and the ecosystem constantly evolving. So excited to be here.
John Carson. I ran one of the biggest market makers in the world during the great financial crisis in the option space, and then now have 4 non-correlated hedge funds focused on options and a wealth advisory business that really is focused on non-correlated investing. They got your name right at least. Mine's spelled with a C apparently, but all good. So the reality is retail pushes much bigger weight than it's given credit for, and retail is not one thing. RIAs you could consider retail. $500 trillion is what the long 60/40 world exists globally, right? And if you think about that, about 75% of that is RIA, family office type investing. So it is not a small thing, and importantly, relative to their size, they also trade significantly more than institutions do. One thing I like to tell people is that the average, this kind of blows people's mind, the average amount that it takes to move the S&P on a daily basis is about $100 billion in the context of $200 trillion of equity exposure. So retail is significant, and its impact and the pressures that it's having across the space.
I want to get into sort of the diversification of ETF products, because when I was coming up at a brokerage a few years ago, it was really, SPY, the Qs, and maybe some thematic ETFs that people were really dabbling in. And now you have ETFs with specific strategies behind them. So Jem, I'll start with you on the options front. How are retail investors discovering and using these types of ETFs in the market today?
Yeah, so what you're seeing, I think that's really interesting, referring back to kind of what I was saying. You have $500 trillion of long assets. And what I mean by that is stocks, bonds, private equity, private credit, real estate. And what you're discovering, and particularly in the last 3 years since 22, bonds, which are really the only thing offsetting the exposure of risk in equities historically, are no longer a diversification. Or cannot be relied on for diversification reasons. What this done has set off a tidal wave of people looking for ways to offset risk and diversify away from stock exposure. It's happened, we've seen it in gold, with a tripling of gold in the last 3 years. It's happened with Bitcoin, which was already on a run, tripling again in 3 years. But importantly, to your options question, options exposure now has gone up 3 to 4 fold as well. Structured product issuance, which is the part I want to get to here, has gone from $500 billion to $2 trillion in the last 3 years. When I say structured products, I'm including the ETFs that are essentially operating like those, as well as mutual funds that offer ETFs and things in that space. The demand is exponential. And again, the reason is, if you count all of those non-correlated, including hedge funds, which are about $4.5 trillion, you're dealing with $15 trillion now, up from 5 just 3 years ago, against that $500 trillion pool of assets. And so these are the early adopters coming into these ETFs, looking for more structured product type exposures, yield, non-correlation, other bets. Options are the vehicle with which they are able to achieve that non-correlation. So retail is waking up to this. When I say retail, again, not just somebody trading a $5,000 account. RIAs are waking up to this. That's where the structured flow volume and the ETF investing is coming from. And so I think people, even though they may not explicitly understand how the options work and what exposure they're necessarily getting from the options, an ETF serves as a translation for that. as a structured product does as well. These are the payouts you're getting and whatnot. So I think that's what's driving that demand. I think it's just in its first or second innings, personally. And retail has been a pretty early adopter there, but lots of room to grow.
Yeah. And Bilal, I'm assuming you're talking to people like Will all week, all day, all the time, different issuers, different products. What are some of the things you're hearing from them in terms of what they're bringing to market and also how they're thinking about differentiating or standing out? As it seems like there's been a proliferation of these products for retail investors.
Yeah, no, good question. So I think, let me provide some context on sort of how I sit in the seat and what I do. So me and my team, we effectively work with asset managers that want to launch ETFs, and we support them with their launch, making sure that they're connected to the right parts of the ecosystem, but at the same time, can we actually support their idea from a distribution perspective? And we are not a supplement to distribution, we're a complement to distribution. And just by background, I spent the first 9 years of my career at Neuberger Berman, which is a small boutique money manager, not known for ETFs, and they weren't utilizing ETFs. And it was in 2015 when I went to BlackRock, where I go to obviously the behemoth, and we spent a lot of time on beta-based conversations. And then I transitioned to a firm called Harbor Capital, where they basically distributed sub-advised partners. So unique money managers, and we would actually wrap them in ETFs and sell them. And what's unique about Will and his team and what issuers are trying to do is they're trying to provide solutions that not only support diversification aspects of portfolio construction, but they're also trying to provide the education, because the opportunity is available to the investor today more than ever. We're talking about democratized finance, but also, can we actually use the more efficient wrapper to extend the portfolio to get the reach that we want? This is very important. The part of the conversation that's not had right now for most investors, it's all about product accumulation. So everyone's saying, hey, we have this new product in the market, but where does it fit? How do we source? That's the part of the conversation where we should actually lean into. It's the diversification aspects, and do we have truly uncorrelated asset classes? So when I'm speaking to these ETF issuers, and what I'm seeing and hearing is you're seeing obviously a ton of stuff going on with crypto. You're seeing a ton of stuff going on with these sort of defined outcome solutions. But I think you will continue to see more customization, direct indexing, and some of these unique opportunities launch here in the next few years.
And Will, I mean, as an issuer, and you talk about building these products for retail investors in mind, but it seems like you need to appeal to a multitude of audiences for that. So when you're thinking of bringing products to market, you started with your commodities and you've expanded. How do you design products that appeal to not only self-directed retail, but also potentially wealth managers, institutional flows as well?
I think it starts with having or designing a solution for a problem that exists in the market. And that problem can be multifaceted, but ultimately, when a product's successful, you're creating a solution for something. Whether that's an income solution, whatever it may be, but you have to be providing a solution to a problem that exists. And then it's really just a question of then the magnitude of that problem. And so that's your total size of whatever that investment opportunity is. And that could be a small problem that you're solving, or it could be a big problem that you're solving. So I think it sort of starts and ends there. And you have to constantly be thinking about what solutions that you can provide. And I think that comes from us. I mean, I always say that we don't have a monopoly on all the good ideas. That a lot of the times, as this community gets bigger, people get way more engaged with investing. We see more and more people coming to us directly and saying, oh, can you do this, or can you provide that? And so the market's evolving so much more than it did a few years ago. And so it's not just a one-way street where we create a product and offer it to the market. It's that the investors themselves are coming to us at the same time with requests and demands for solutions.
And Jem, I want to ask you, for the family offices coming to you and the people you advise, are they coming to you with specific products or brand names for issuers in mind, or is it, I want to solve for XYZ, and then you pair them with a product that you think does that well?
In my case, definitely this is a problem I want to solve. How can you help me do that? That said, there's definitely the occasional, hey, I've been looking at this ETF from these guys that I, have some other ETFs, what do you think, right? And so there's a bit of that. I do think, even though there are now, 4,500 ETFs or more ETFs than stocks now, I think the amount of concentration of the kinds of ETFs is dramatic. There's still lots of room for new, unique products. I think, particularly on the non-correlated side, I think there's a lot of issuance going towards retail flows that are looking for a certain type of exposure, certain acceleration, right? But I think in terms of products that are really a structural fit for that $500 trillion world, there aren't really as many as you would think for non-correlation. And so I think that is particularly interesting. That's something, a conversation we're having a lot more with people. We do a lot of these solutions bespoke in people's managed accounts, but there are scalable solutions that can be done in ETF form as well. I mean, I'll highlight, I said structured products earlier. Structured products on average have about 3% annual fees. And they're liquid, and you have counterparty risk in the form of the issuer. A lot of these products, which are not yet issued, by the way, in ETF format, primarily because a lot of them are exotic and they're kind of hard to structure and hedge. But there are definitely similar solutions that can be done at a fraction, call it a third or a quarter of the fees. And those solutions are incredibly compelling in a liquid format with no counterparty risk. So that's what we find ourselves doing a lot for clients, and we can't do a lot of things we're looking for. So we'll probably be issuing some ourselves as well.
Any insight into what those might look like?
Because our competitors here are in some form or another crowd, and others probably
I'm
won't
trying to make it
tell
weird.
you before I issue it, but yes.
Will, just put the earmuffs on.
We're not direct competitors.
I'll be here.
Granite is, they do great products, and they're really focused on a lot of the retail acceleration space, et cetera. So it's an area that we wouldn't play in, but great products.
Yeah, we'll jump off of that, Will. What's next in terms of, there's so many different strategies you might be able to build an ETP or ETF product around. Are there any emerging strategies that are top of mind that Jem could hear and not steal? What's next? We have the options. We have the single stock leveraged. What else is out there that's technically possible?
I think it's just to riff off of what Jem was saying. Another way to say it is that the trend that has been, I think, very strong over the last few years is the retailization of existing institutional trades or strategies. And so whether that's the structured note world or other types of payoffs that institutions or hedge funds, et cetera, would trade, very much the theme is packaging those in an ETF form. Like the ETF was one in terms of that's the wrapper of choice for the market. It's just a question of like how many different payoffs can you wrap within the ETF structure. So in my mind, that's where all of this is going and continues to go. And the question of deliverability is not just a sort of a raw architectural question. It's about the change of regulation, and as regulations adapt, we're able to do more of these things.
And Bilal, for you, are you seeing any interesting patterns, the conversations you're having, maybe things that are more or less popular than say 5 years ago? I'm thinking I remember in 2021, there was a lot of niche thematic ETFs. There was a music ETF. There was an ETF for
They still
anything.
exist, by the way.
Yeah. They're fascinating, but back then it seemed like they were more thematic in nature, and now it seems like they're more these outcome-based, strategic. What are you seeing across the conversations you've been having?
No, this is a very relevant question because, asset managers or ETF issuers, they get excited to launch a product, but they should be just as excited about their distribution strategy and what their commitment is to raising capital. It is very difficult. It's hyper-competitive. And it's very difficult to also identify attribution as far as where's your ROI and who's actually buying the product. So the thematic conversation has shifted to these solution-based opportunities, but where there are captive dollars and or an opportunity to raise capital. So, the things that we have seen, I would say, come off the market are these very niche thematics that don't have an opportunity to raise capital. So I'm not going to point to any names, but look, we're all running businesses. So at some point you have to break even and or start making money. So if you're not raising capital, you're not going to do that. So you're not going to survive. So what we have seen is some consolidation. We've seen asset managers look to actually acquire particular books of businesses. We also see some innovation with, you probably heard this, the 351 exchange. This is a massive opportunity to leverage the ETF wrapper to actually grow asset bases for the advisor world, so the RIA world, but also we see communal groups coming together and doing so as well. And that's a way to also open up a new investment product. So the other areas that make a lot of sense right now, fixed income. You're going to see still legacy managers come into the fixed income space. I think that's the biggest opportunity, obviously the size of the market relative to the equity market, but also the precision that these money managers will be able to build for durable portfolios. And I think that's going to be a major opportunity given the silver wave that we continue to see coming. And obviously people want to de-risk their portfolios. And you will also see the expansion of other product types, to your point, around these structured products. I think that's where you'll continue to see opportunity. But think about this also. You're going to take the same, sorry not to cut it off, but you're going to take the same principles that we've applied to traditional equity strategies, and you're going to see that in crypto. And I know Will's probably doing something there. Don't let it out the bag. Don't let it out the bag. I'm just saying, like, that's what you're going to see. You're going to see that.
But I guess on that point, Will, and then I'll go to Jem. When you're coming up ideas for new products, how do you know it's a high conviction idea when it seems like retail investors' appetites and preferences are changing, the macro environment's changing? How do you go to market or invest in building something new, knowing there's a pretty good chance it's going to have traction among retail?
I mean, to some degree, that's the secret sauce.
Okay.
That defines, how
We're just getting into it up here today.
Or not. I mean, because at the end of the day, if you think about, what we do is just the same as any product company, right? Regardless of whether you're producing electronic goods or, in our case, producing ETFs, that you live and die by the success of your products. So if you launch rubbish products, then you're not going to go far as a company. So to that degree, it's always that combination of you want to try and solve a problem that exists, give people a solution to something that they're looking for. It's crowdsourced as well in some cases where there may be something that the investor sees that we haven't thought of, or it's a regulatory change or a market condition that allows something to happen that you know just intuitively that there's going to be demand for it. It's just a question of what's the unlock that makes it happen. And for leveraged single stocks, a small example, leveraged ETFs have been around for a long time, well over 15 years. There's nothing new about leveraged ETFs, but no one ever done leverage on a single stock. And then that changed when the regulations were updated, and that provided an unlock that enabled us to launch the first leveraged ETFs on single stocks. And that was a massive category, or it is a massive category, and will continue to grow.
Jem, how do you think about that? Because I'm curious, I've always been fascinated with how these ideas for ETF products come to life. At a smaller business, at a bigger business, someone just has an idea and they're like, hey, I think we should do this. When you're kind of planning ahead and thinking about building these types of things, how would you go about, balancing instincts with data, with what's going on in the world around you?
Yeah, for me, I really start with, where I see things going more broadly, right? Where is the world going? Where's investing going? What are the themes? What are the big ideas? Because with any business, if you get that part right, you can get in the wrong neighborhood, but you'll eventually end up in the right place. Then just like any other business, and you're trying to get the right product, you go talk to your potential clients, right? So we're talking with RIAs day in, day out, talking with family offices day in, day out. And the best way to do it is to have some promised money in hand coming from them to begin with. When they say, wow, that's something I really want, well, how much would you like if I built it? And you go from there. That's kind of the best approach for me and kind of what we're following with a lot of products that we're releasing. I will say, just to kind of put a bow on that, what does that mean in real terms today? I mean, the bond market, right? Everybody's pulling out of duration and has been for years. It doesn't know where to put that 40%. And I think that's what's yielding to the boom, the boom in more non-correlated yield generation, et cetera. I think that's the first thing. I think the other thing there's a lot of demand for there's not enough product for is long volatility, like a hedge to that equity exposure. That's still, there's interest there, and that's something that we're also looking at. But I think the thing that has yet to really come to market and will probably come once again, much like when stocks and bonds didn't work, people moved away from bonds. When equities don't work for a while, I think you're going to get some interest in more non-correlated exposure there. And so I think that would be the next thing after that more broadly. But I do think there's a broad move, as we've talked about already, to more non-correlated away from bonds and stocks in general. It's just a kind of a progression that we're going through.
And quick follow-up, you mentioned 60-40 portfolio being dead is something people love to throw around. What if it's not 60-40? What is that? How would you describe the next evolution, or is it really going to be different for everybody?
Yeah, this could be a whole other conversation, but I will say the following: that very few people know that 60-40 over the last 125 years is a 0.35 short. Not very good. It's had a 0.6 in the last 40. 0.25 in the 80 years prior. And the success of it in the last 40 years since 1982 is a function of interest rates going from 19 to 0. It's that simple. And as interest rates go higher, there's a higher probability of dramatic underperformance of it. I'm not the only one saying that. This is not a unconventional conversation at this point. It's just most people don't know it yet. And so once you understand that concept and the pressures driving interest rates higher, the basement, all other kinds of macro things, you begin to see the next 10 years in a very different light in the products that will be under demand in that context.
Something I think fascinating happening across the ecosystem, whether you're a fintech app, a platform, an issuer, a public company, is just this battle for attention and wallet share. And so I want to ask you, Bilal, when people are coming to you for guidance around distribution and how to get these products in front of people, marketing is an aspect of that. What general guidance do you give these companies in terms of how to stand out? Because it seems like there, as someone mentioned, the 4,500 ETF products, and then it's not just the brand recognition. It's you're fighting for dollars within a portfolio that is increasingly managed within one app or platform. So what are you seeing there?
Yeah, so this is a conversation that needs a lot of thought to it. So because I was in sales and distribution, I spent a lot of time actually raising the capital directly with the advisor. And the one thing that I always knew is that I would have a conversation with the advisor, and you all, business people, you will have a conversation with anyone who says they have an opportunity to put capital in your pocket. Most people will. You say, okay, how do you support that? The one thing that I realized quickly, though, is really good advisors won the end buyer or retail investor faster. Let me say it this way. When I was at BlackRock, I felt like I had every resource possible to communicate to the advisor, to say, hey, despise Vanguard and buy me. That's what I felt like, and I would give them everything. Vanguard didn't have a salesperson to actually communicate this. They would say to me, Bilal, my client needs to see Vanguard, which means they bought Vanguard before I bought it, and they were comfortable because Vanguard sold low-cost beta exposure. No problem there. Today, we see good managers, like the two that are sitting here, they actually build affinity and relationship with the communities of their investors. So the one thing that we spend a lot of time with is saying, do you have a retail distribution focus to actually grow visibility for your products? The last panel, they talked about certain products not being available on certain platforms. So everyone can actually acquire or purchase the product, which means you need to be able to go direct to consumers to buy the product and build visibility. So one, do you actually have access to unique data sources? Again, attribution is really, really difficult in this space. So are there unique data sources where we can actually track some of the ROI? The second component is, do you actually have the value proposition to unlock the opportunity where people want to hear you? It's 4,600, 4,500 products. What differentiates your hedge strategy from the other? And then how do we communicate that value? That is very, very difficult because, again, it's just all product allocation. People are just buying products, not knowing how they actually fit in the context of the portfolio. So can you communicate that value? And the last piece is, do you actually work with really strong, supportive third-party strategic partners? This is important because just like you with the folks here at StockTwits, and it's the same conversation that we're having, can we actually expand that relationship to actually help drive visibility for some of these managers? So we're spending a lot of time talking about these strategic pillars to actually build relationships out in the field with potential consumers and obviously product buyers.
Yeah. It's fascinating because it seems like different issuers have different advantages in going to market. You have people like iShares, all the money in the world, Invesco, and they sponsor the entire NCAA tournament every year.
Do you know why?
Cost of print.
Do anybody know why?
They can't spend the money elsewhere.
They have to spend the money.
Yeah.
That's the unique part about it. They have to spend that money on marketing, which is crazy. But we all don't have that marketing budget.
Yeah, it's wild though. There's limitations of where they can, how they can do it. And I want to ask you, Will, sort of what, because it seems like some companies, there's a thought leader, Kathy Wood. Some companies, it's outcomes based. You're showing value in the results. Other companies, not an issuer, but Travis Kelce is now somehow involved in Six Flags, which I'm sure is going to help them a lot. How do you think about that at Granite Share? Sort of what's your advantage that you guys have in going to market?
Yeah, I mean, you make a good point, which is that there's no single right way to do this, that everybody has their own style. I thought you were about to say that Travis Kelce was coming out with an ETF.
I know.
He's an activist investor now. He probably would. What would be in that ETF?
We've reached peak ETF at that point.
Yeah, like Red Bull, and McDonald's, all fun things.
But I mean, I think that's ultimately the problem every business has, right? How do you differentiate yourself in the industry that you operate in? How do you provide a compelling value proposition to your customers? How do you stand out? And for us, that's always been the case as being an independent firm where, we're not backed by or owned by a bank or other big sort of corporation. We live and die by the success of the products that we offer. And slowly but surely, we try and evolve and add different things where we can differentiate, whether that might be specific forms of marketing channels, or it might be different countries that we access that some of our competitors don't, different types of product. But ultimately, we're all trying to do the same thing, which is provide a compelling value proposition and differentiate in a world where it's a very competitive industry and people have a lot of choices.
Yeah. I think we have a few minutes left for audience questions. So if anyone, you sir, I don't know if there's a microphone, but maybe you can shout it on out. Not to put you on the spot. Oh, here comes the microphone. There we go.
Hey guys. So you guys mentioned 60-40. Larry Fink recently said 50-30-20 is most likely where it's going, with 20% being in privates. And we've been seeing, we actually shifted from institutional to opening up our marketplace to retail as well. And we've seen huge interest. Curious what you guys are thinking on privates and bringing that to market.
I have a strong opinion on this one. Privates largely are not a diversifier. We're seeing, actually you could argue it's an accelerant to the exposure, right? This is things that are taking off market, longer duration, 2 to 3x leverage for those assets. It's literally called private equity and private credit because they are equity and credit, charge 2 and 20 fees. It didn't matter for the last 20, 30 years. The growth has been meteoric because the volatility is not seen because they're not marked to market. But what we haven't seen in the last 30, 40 years is a period of decline in the market that was meaningful, that lasted longer than 5 years. And historically, these happen quite abundantly. And so my view, and it's a strong view, and I think the market is starting to catch on to this, by the way, if you're watching what's happening in private credit and private equity right now, that in a liquid product, if you're at the end of a cycle, there's no liquidity, ultimately, like true liquidity for these products. It doesn't matter if the market's going up the next year or two. If you ultimately think that things are risky for the next 5 years, you're going to want to get out of those liquid things before. Again, private equity, private credit are not a diversifier. They're not non-correlated. Just because you can't see the market doesn't the values aren't moving underneath the hood. Strongly believe, it is unfortunate that I do see a lot of late stage people trying to move away from equity, calling, privates alternatives and move into those things. But the reality is this is probably the worst time to be doing that.
Any other questions from the crew?
Katie, I got one.
Okay, Alan.
So tokenization of real world assets, that's obviously a theme that's bubbling up. How does that play out in your world? Interested in your perspective.
You guys want to take that?
I think that's kind of one of the big questions that is relevant today. I'm not sure I have an answer to it, to be honest with you. It sounds a little bit to me like different sort of fads that we've had, which purportedly offer, some kind of panacea to invest. Like, for example, direct indexing was one the last few years. And I think it all comes down to, at the end of the day, the value proposition. And the value proposition for ETFs is unbelievable. And direct investing or direct indexing, something that just ultimately couldn't compete with the value proposition that was already created through ETFs. I mean, ETFs are practically free, for goodness sake, trade like water. So the tokenization argument has to solve that fundamental issue, which is how does it make the experience better? Or what problem is it solving? And I think in certain cases it will absolutely solve the problem, whether it's a investor in a foreign market, for example, that doesn't have a sophisticated or developed local equity or bond market that has access to an iPhone but doesn't have access to capital markets. Maybe that's the way that they get access. But I'm not sure I know if there's a broader use case than that.
I'll briefly, look, the polymarket deal for us, so we made a big splash there. The commitment to the innovation in the space is there. And I think that's obviously $2 billion allocation is important. But I think the industry has capital market infrastructure challenges that no one probably wants to pay for either, and it takes some time. But when you talk about speed, efficiency, security, ultimately that is effectively where we will go with smart contracts and all this other stuff. So, but it's going to take a long time.
Yeah, I'll just echo that. Theoretically, absolutely, it makes sense. There's a lot of ideas that theoretically make a lot of sense. The problem is the practical realities get in the way of that, and it, I think over time we will bend towards those solutions. But I think the timeline with which it's going to take is infinitely longer.
Right, I think that is us for time on this panel. Thank you everyone for stopping by. Thank you to our amazing speakers, Will, Bilal, and Jem. There will be somebody, I believe, in the back who will walk everyone towards lunch. There he is. Or do you have a question? Or you're walking? Okay, cool. You can ask a question while you walk. We'll be back here afterwards for more sessions. Thanks, everybody.
Cheers, everyone.